In this video, I'm going to show you 16 different ways of anticipating a trend reversal. A whole course can be made for each one of these methods, so keep in mind that I'm only going to give you the highlights of each method or technique. Without further ado, let's begin. The first way of anticipating a trend reversal is by looking at psychoanalysis. Psychoanalysis is not a very widely known method, but it can be very powerful when applied correctly and when combined with other tools. Before we understand how cycles are used to anticipate a trend reversal, we need a few basic ideas. Think of a cycle as a wave that oscillates up and down like you can see in this image. The cycle amplitude is the height of this wave. The amplitude from a trough to a peak is called upcycle amplitude, and the amplitude from a peak to a trough is called downcycle amplitude. The cycle length is the distance between two peaks or the distance between two troughs. We can analyze the highs and lows in a price chart with these elements in mind. For example, in an uptrend, the upcycle amplitude is generally larger than the downcycle amplitude. That's why price progresses to the upside. The net change in each cycle amplitude is positive. Notice also that in this image, cycle lengths are equal, meaning that the horizontal space between peaks or between troughs is the same. In a downtrend, the downcycle amplitude is larger than the upcycle amplitude, creating a negative net change. That's why price progresses to the downside. In this example, the cycle lengths are also equal for simplicity's sake. In terms of cycle amplitude, there are three possible types of price action: neutral, converging, and diverging. These names come from the relationship between highs and lows. In this image, you can see an example of neutral price action, which means a constant cycle amplitude. The highs and lows are parallel. This means that the trend is balanced and therefore sustainable. In this next image, you can see an example of converging price action, meaning that highs and lows are approaching each other by a gradual decrease in cycle amplitude. There is a decrease in volatility, which means that there is a decrease in trend power. In this next image, you can see divergent price action, meaning that highs and lows are getting apart from each other. This means an increase in volatility and the fact that the trend is getting stronger. This is a sign of trend continuation. The same exact logic applies for a downtrend, of course. The other way of looking at cycles is through their length. As a general guideline, a gradual decrease in cycle length is a sign of trend weakness. A decrease in cycle length while cycle amplitude is maintained will naturally produce movements that are not sustainable. Movements that go through a wide price range in a short amount of time are exhaustive, even though they appear to be strong. Since exhaustive movements like that are not sustainable, it leads to the conclusion that a gradual decrease in cycle length is a sign of an imminent reversal. On the other hand, a gradual increase in cycle length while amplitude remains equal is a sign of continuation. That's because there is time for price action to create up and down movements in a sustainable fashion. In terms of cycle analysis, there are two signs to look for when scanning for a power decrease in the trend, which means the possibility of a trend reversal. The first is a gradual decrease in cycle amplitude while cycle length remains constant, and the second is a gradual decrease in cycle length while cycle amplitude remains constant. We are looking at these possibilities in isolation, but they can occur in synchrony, which will lead to different signals. I will leave that for another day since psychoanalysis goes way beyond this brief introduction. Another way of assessing the strength of a trend is to analyze the size of retracements. If the retracement size is decreasing, it means that the dominant market player is becoming more powerful, and therefore, the trend will pick up speed. If the size of retracements increases, it means that the dominant market player is becoming less powerful, and therefore the trend will slow down. In this illustration, you can see how the overall trend seems to slow down as progressively larger retracements appear. A larger retracement means that the subdominant market player has more space to breathe. The opposite scenario can also occur, indicating an increase in the power behind the trend. The classic example of this is when the trend is reacting to a well-established sloping channel, like you can see in this image. In a certain point, the expectation that the market will retrace to the channel boundary is frustrated, which immediately translates into a retracement with smaller size. After that, price breaks to the other boundary of the channel and there is an increase in trend power. Another way of assessing the power behind the trend is to look at the candlestick ranges. The candlestick range is nothing more than the distance between the candle extremes. The average candlestick range can be easily observed through the ATR indicator, which stands for average true range. A decrease in the average true range means that candlesticks are narrowing, which implies that the dominant market player lacks the power to produce powerful wide movements in the trend direction. A decrease in ATR while price advances the trend direction is a sign that the power behind the trend is weakening. In this illustration, you can see that a decrease in ATR while price is advancing to the upside is a sign that the trend is weakening. A decrease in ATR while price is advancing to the downside is also a sign that the trend is weakening. The bullish and bearish signals are the same because the ATR cannot have negative values. Logically, an increase in ATR is a sign that the power behind the trend is increasing. One subtle way of assessing the sustainability of a trend is to analyze something called price persistence, which is the quality of price action. The property that makes price action sustainable is when candlesticks have approximately equal medium ranges. Whenever price decreases or increases candle range too much, price action ceases to be sustainable, or in terms of price persistence, it ceases to be high-quality price action. Candle ranges that are too narrow produce things like inside candles, which are often present at reversals. And candle ranges that are too wide produce things like exhaustion candles, which are also present at reversals. In other words, the continuity of a price movement relies on candlestick ranges not being too narrow nor too wide, relatively speaking. Take a look at this illustration. This is an example of sustainable price action. All candles display roughly the same medium range. This means that a movement like this can continue for a long time because price is balanced. In this next illustration, you can see one of the examples of unsustainable price action because candle ranges begin to narrow as price advances. This is what we talked about previously. In a situation like this, you would see the ATR indicator dropping. The other example of unsustainable price action is when candle ranges begin to widen, as you can see in this other illustration. Price cannot continue creating progressively wider candles like this, so this is an exhaustive movement that eventually leads to a reversal. Either narrowing or widening candle ranges will produce a reversal. The only possible way for price to continue in one direction for a long time is when there are medium ranges. The candle stochastic is simply where the closing price dwells in relationship to the candle range. Generally speaking, if candlesticks are closing on their upper range, it means that there is more bullish pressure than bearish pressure, and if candlesticks are closing more on their lower range, there is more bearish pressure than bullish pressure. In other words, candles closing more on their lower range on a bullish trend is a sign that the trend is weakening. Candles closing more on their upper range on a bearish trend is a sign that the trend is weakening as well. In this illustration, you can see that the candle range remains constant, but the candle stochastic changes over time. In an upward price movement, the decrease in candle stochastic means the selling pressure is beginning to appear. This relates into more prominent upper shadows. In a downward price movement, the increase in candle stochastic means that buying pressure is beginning to appear. This translates into more prominent lower shadows. Notice how this naturally gives rise to the famous hammer and inverted hammer candlestick patterns, which often appear at price reversals. We can also look at what's called the candle body to range ratio, which is simply the ratio between the candle body and the candle range. Let's take a moment to think about what this means. A candlestick with a wide range and a wide body, which naturally produces small shadows, is a sign of certainty for the most part. A candlestick with a small body in relation to its range, which naturally produces large shadows, is a sign of indecision. Buyers and sellers are fighting, but there is no clear bias in the candle body. The natural conclusion here is that a lower body to range ratio means that the price movement is weakening. In this illustration, you can see how the decrease in body to range ratio transitions the price movement from certainty to uncertainty, especially when the candle stochastic remains centered. Notice also how this combination of decrease in candle-to-body ratio and centered candle stochastic naturally gives rise to the spinning top and spinning bottom candlestick patterns, which generally mean indecision. It's always interesting to observe the body-to-range ratio in combination with the candle stochastic, as these two things will provide complementary perspectives on price action. We can observe the power behind a trend by seeing its overall angle. Trends can rise at a steady angle, usually when there is the element of price persistence or sustainable price action that was previously discussed. They can start to accelerate or they can start to decelerate. The trend acceleration means that the trend is getting stronger, but it also means that this acceleration is inevitably leading to an exhaustion due to the unsustainability of price movements with too much volatility in a short period of time. The deceleration angle means that the trend is losing power and a reversal might take place. In this image, we see an example of sustainable price action where the overall trend angle is steady. It doesn't accelerate nor decelerate. In this illustration, we can see the overall trend angle getting less steep, which suggests a deceleration in the trend or a power decrease, which tends to lead to a reversal. In this next image, we see the overall trend angle getting steeper, which suggests an acceleration in the trend or a rise in power. This leads to an unsustainable exhaustive price movement, which itself tends to lead to a reversal. In technical analysis, one major way of establishing the likelihood of a reversal is price proximity to a strong barrier. It's not uncommon to see a major price reversal happening at a strong barrier. The greater the strength of this barrier, which can be assessed in many ways, the greater the possibility that price will reverse at it. The key here, of course, is investigating how strong the barrier really is. You must pay attention to things like how many times this barrier has been tested in the past, the relevance of the barrier origin, and how price reacts to this barrier when it reaches it. These three elements must give you a good idea of whether the price barrier is strong enough. Keep in mind that there are many different types of price barriers. Some of them are obvious like support and resistance lines, and some of them are not obvious at all like frequency lines and different types of sloped lines. Price can travel the same distance in different ways. This relates to the depth of trend oscillations. With a high oscillatory component or with a low oscillatory component along the way. When there is a high oscillatory component in a trend, it tends to be more reliable because there is profit taking in the retracements and price has time to breathe, so to speak. When price movements occur too rapidly with a low oscillatory component, there's not much time for profit taking, so the movements tend to be unsustainable. This is a little counterintuitive because powerful price movements in one direction give the impression that the market will continue rising, but these powerful price movements are not sustainable in most cases. Another interesting way of seeing beyond what candlesticks show on the surface is through volume spread analysis. If you don't know how that works, I have a free course about it here on the channel, which you can check out in the video card or video description. There are 4 classic patterns in VSA. 3 of them suggest a trend reversal and 1 suggests a trend continuation. This yields the best results when price is encountering a strong barrier. A low volume wide range candle stopping at a strong barrier suggests that shallow supply or demand has been consumed throughout the course of the candle, and price has now encountered a deeper liquidity pool, supposedly at the strong barrier. This indicates a possible reversal. A high volume wide range candle suggests that the dominant market player has power, so the trend is likely to continue and there is a greater chance that price will break through even a strong barrier. The other 2 reversal patterns of VSA are related to narrow range candles. Rather ambiguously, both high and low volume narrow range candles suggest a reversal at a strong barrier, but for different reasons. A low volume narrow range candle means that there is not much interest in the current side of the market, so the other market player can enter the scene with more ease. A high volume narrow range candle means that the dominant market player is aggressively attacking and the side being attacked is successfully defending the attack, creating a high action in a narrow price range. If this happens at a strong barrier, there is an indication that a reversal might take place. Velocity and volume divergence are among the most reliable trading techniques out there. A lot of traders call velocity momentum, but true market momentum is the combination of velocity and volume. I will leave that for another video since this topic deserves special attention. Velocity is nothing more than the rate of change. Indicators like the RSI, for example, measure the rate of change of price given a fixed window of calculation, usually called period. At the end of the trend, it's common to observe the standard reversal divergence signals in terms of velocity and volume. A bearish reversal divergence will occur at the end of a bullish trend and is characterized by higher highs in price action and lower highs in an oscillator like the RSI. A bullish reversal divergence will occur at the end of a bearish trend and is characterized by lower lows in price action and higher lows in the RSI. Volume divergence is also a powerful tool, and it can be seen in different types of volume indicators. The most common type is volume divergence through the simple volume histogram. In an uptrend, volume divergence occurs when price creates higher highs and the histogram creates lower highs. In a downtrend, volume divergence occurs when price creates lower lows and the histogram creates lower highs. Notice the nuance here since the volume histogram only has positive values, so we only look at peaks in a histogram. Another possibility is by observing volume divergence in a cumulative volume indicator like the OBV or the cumulative delta volume, which yield pretty much the same signal. These indicators have positive and negative values since they are cumulative, so the divergent signals are exactly like the ones we find in other types of oscillators like the RSI. For bearish reversal divergence, we observe higher highs in price and lower highs in the cumulative volume indicator. For bullish reversal divergence, we observe lower lows in price and higher lows in the cumulative volume indicator. Divergent signals can also provide insight into the continuation of a trend. The heuristic for continuation divergence goes as follows. Higher lows in price in combination with lower lows in an oscillator yield a bullish continuation signal. Lower highs in price in combination with higher highs in an oscillator yield a bearish continuation signal. The combination of velocity and volume divergences happening simultaneously increases the strength of the signal. This would be a true momentum divergence. Another powerful and yet very simple way of assessing the trend is through one of the tenets of the famous Dow theory. In the theory, an uptrend is marked by successive higher highs and higher lows, and a downtrend is marked by successive lower highs and lower lows. We can spot a change in the trend when there is a change in the relationship between highs and lows. That doesn't always happen, of course, but when it does, it is clear the market has transitioned from a trending movement to a sideways movement, and that gauges the type of trade signals you should look for in the chart. In this illustration, we can observe the transition from an uptrend to a sideways market just by observing this relationship between highs and lows. In the trendy part of the movement, price is creating higher highs and higher lows. As soon as price starts to create flat highs and flat lows, we have a sideways market, which might lead to a reversal, but it also might lead to a continuation in certain cases. In this other illustration, we can see the same pattern in a downtrend. Lower highs and lower lows mark a downtrend, and as soon as price starts to display flat highs and flat lows, we have the transition to a sideways market. Once again, the point here is that this can be an indication that there is going to be a greater reversal. The important thing is to keep an eye in this relationship between market extremes. Another very famous methodology that deals with market phases and therefore market trends is the iconic Elliott wave theory. According to the theory, the market moves in patterns of 5 and 3 waves that repeat across different scales. If you can spot a trend with 5 clear waves, there is a higher chance that this trend might be near its end, or at least near a greater retracement. The Elliott wave theory is very famous, so it's one of those things subjected to the self-fulfilling prophecy effect that we can find in certain technical tools. That means that even if the Elliott wave method doesn't make scientific sense, the fact that there are tens of thousands of traders believing and acting as if these rules were true make them work to some degree, and that might be enough to help nudge price into a reversal. Since we are talking about assessing the power behind a trend, you want to observe the completion of 5 or 3 clear waves in the chart. When that happens at a strong barrier, for example, there is a slightly higher chance that the market will reverse with more power, because beyond the traders looking at the strong barrier, we will also have the help from the traders looking at the basic Elliott wave patterns. If you wish to learn more about Elliott wave theory, I have a free course here in the channel that you can check out in the card or the video description. The Wyckoff trading methodology, which you can learn in depth for free here in the channel, in the card or the link in the video description as well, is part of the big three of market phase analysis along with Dow and Elliott. Wyckoff points to manipulative patterns that happen at the very beginning or end of a trend depending on your perspective. This manipulative maneuver is created by larger traders that have enough capital power to nudge price in certain places and enough power to absorb supply or demand in certain places to steer price action in their desired direction. The movement at the end of a downtrend is called spring, and the movement at the end of an uptrend is called upthrust after distribution. If you can spot the signs of an upthrust after distribution or a spring, you will have an advantage over the traders who cannot see it. Spotting these events in combination with other tools might give you a real-time insight about the end of a trend. There are many details in the Wyckoff method in the same way that there are many rules in the Elliott wave theory. I can briefly give you the general gist of the manipulation patterns in this video though. In the spring pattern, price produces lower highs and lower lows, eventually losing strength and transitioning to a sideways market, meaning flat highs and flat lows. This suggests the creation of upper and lower limits of a range. There are many retail traders that wait for the breakout of the lower limits of the range in order to sell because they think this is a sign of continuation in the trend, which might be in some cases. However, large traders that have the capacity of absorbing supply or demand know that retail traders think in that way, so they can purposefully induce a breakout just to trigger the retail traders to the downside. This generates a deep liquidity pool. A lot of supply in this case comes from the retail traders. Large traders can then absorb the supply by entering many long positions in a narrow price range. This is what happens at the spring event. Eventually, retail traders realize that the market will not continue to the downside, so they start to reverse their positions to the upside. Meanwhile, the large traders are already in the market with a lot of long positions from the absorption. From this point, an uptrend begins. Notice that under the Wyckoff method, the large traders, which are also called well-informed traders, are always one step ahead of the retail traders, which are also called uninformed traders. In the upthrust after distribution pattern, we have the exact same paradigm, but upside down. Price produces higher highs and higher lows, eventually losing strength and transitioning to a sideways market, meaning flat highs and flat lows. This suggests the creation of upper and lower limits of a range. There are many retail traders that wait for the breakout of the upper limit of the range in order to buy because they think this is a sign of continuation in the trend, which might be in some cases. However, large traders that have the capacity of absorbing supply or demand know that retail traders think in that way, so they can purposefully induce a breakout just to trigger the retail traders to the upside. This generates a deep liquidity pool. A lot of demand in this case comes from the retail traders. Large traders can then absorb this demand by entering many short positions in a narrow price range. This is what happens in the upthrust after distribution event. Eventually, retail traders realize that the market will not continue to the upside, so they start to reverse their positions to the downside. Meanwhile, large traders are already in the market with a lot of short positions. From this point, a downtrend begins. Chart patterns receive a lot of hate sometimes due to their impressive ability of yielding late signals. However, certain chart patterns can help confirm the end of a trend with a little more clarity. For instance, seeing a double top or bottom or a triple top or bottom at the end of a larger price movement is never a bad thing. These two patterns can be used more accurately, unlike the head and shoulders or inverted head and shoulders, for example, which only have their signals confirmed when the significant reversal has already taken place. If you think about it for a moment, the appearance of a double or triple top or bottom after a strong trend matches the idea found in Dow theory. Double or triple tops or bottoms mean that highs and lows have stopped progressing in trending motion. The simple chart patterns just give another perspective in this case. You can check out a complete chart patterns course here in the channel for free as well. Along the lines of chart patterns, we also have harmonic patterns, which are a little more challenging to see for the beginner, but they can yield interesting results. Harmonic patterns take simple high and low patterns and provide a sort of roadmap for their occurrence. According to the theory, the reversals tend to be more likely when sequential market extremes respect certain vertical ratios. Certain harmonic patterns tend to occur more in the continuation of a trend, and certain harmonic patterns tend to occur more at reversals. For example, the alt bat, the butterfly, the crab, the deep crab, the shark, the AB equals CD, and the three drives can all yield interesting results at the end of a trend. Other harmonic patterns yield interesting results in terms of trend continuation. That's the case with the bat, the Gartley, the cipher, and the 5-0 patterns. I have a free harmonic patterns course here on the channel as well, in case you are interested in learning about such patterns in greater detail. The goal of this video is to show you that there are many different and valid ways to anticipate a trend reversal. Perhaps most importantly, you should understand that the best results will occur when you combine these methods together. That's because the father of all principles in technical analysis is the principle of integration. Integration is when we combine different techniques together and act at their intersection. Instead of trying to master just one of these methods, you should aim to become reasonably good in all of them, to the point where you can see and trade their intersections. That's the ideal scenario for the technical trader. That's it for this video. If you enjoyed the work I do here in this channel, please help support it by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. If you wish to learn how to trade using the best techniques available, check out my premium courses in the video description. If you made it this far in the video, thank you very much for watching, and I hope to see you in the next videos. Take care.